Last year, we witnessed the Great Resignation, in which an all-time high number of people quit their jobs. The Great Reset, in which it was predicted that by 2030, you would own nothing and be content. The Great Wealth Transfer, in which it was predicted that millennials would inherit $35 trillion. And now, we are witnessing what may be the greatest wealth transfer. Welcome to Finance Dojo. We aim to be the best personal finance educational channel you'll ever need. Click that subscribe button and the notification bell right now so you won't miss out. So far in 2022, Nasdaq has entered a bear market. Hundreds of equities are trading at their all-time lows. The economy has begun to decline. Inflation is at its highest level in 40 years, and a recession is surely on its way. Despite all the terrible news, I'm going to break it down for you right now, backed up by research, figures, and historical data. That way, you'll be able to observe firsthand how crucial the coming months will be. Now, before we get into the ramifications of the stock market, house prices, and cryptocurrencies, let's take a look at the present status of the market, because the recent downturn can be broken down into three categories. First, there's inflation. Wages climbed in tandem with demand, forcing firms to swiftly staff up to fulfill orders and produce, and prices jumped to a 40-year high. However, it wasn't the definition of transitory, where things went awry. It's vital to note that high inflation isn't enough to drive anything to start selling off on its own. Second, interest rates are quite high. This includes a 25 basis point rise in March, a 50 basis point rate hike in May, and many other 50 basis point rate hikes scheduled for the remainder of the year. Greater interest rates, on the other hand, make stock market values appear less tempting. Mortgages cost more to borrow, firms must pay higher overhead, and the ordinary consumer has slightly less discretionary income. Third, uncertainty. There is a concern that businesses will begin lay off people, such as Robinhood, which just laid off 9% of its workforce. Slowing demand prompted Rocket Mortgage to shrink, and it's realistic to predict that this trend will extend across many more businesses. Let's start with the stock market, which recently saw its biggest collapse since 2020 and is still down significantly. The Nasdaq is down more than 30%, the S&P 500 is down 17%, and the Dow Jones is down 13% from its peak, with a typical retail portfolio being down 20%. Even if it's tempting to believe that everything is priced in the stock market and that we'll see rate rises in a future recession, everything is great. At 4,000, the recession probabilities contained in the S&P are close to zero, according to DataTrek. A 50-50 chance of a recession equals a 35-25 S&P. Morgan Stanley agrees, predicting that the S&P 500 may fall as low as 3460 if profit growth slows due to recession fears. They also stated that in the previous 10 years, stocks have seen significant losses in the first 4 months of the year. 6 saw the market continue to fall into December, and just 2 witnessed returns of more than 10%. Stock market losses, on the other hand, are little in comparison to the second topic, cryptocurrency. According to CNBC, 40% of Bitcoin investors are now in the red, with prices down more than 55% from their peak. It's important to note this because over the last year, Bitcoin was frequently viewed as a hedge against inflation, a way to store value, and a way to protect against market volatility. But as we've seen this year, there's very little correlation, and it's following the same path as tech stocks. In other words, when interest rates rise, investors take a risk-averse stance and shift their money into less volatile, safer assets, causing cryptocurrencies to suffer. Fundstrat Global predicts a bottom of 29,000 a coin shortly, and El Salvador is still buying the decline. However, we've been trading considerably below the stock to flow model's target price for almost a year. As a result, investors don't consider this a haven asset just yet. Although nothing is safe in this market, including real estate, the immediate impact is that rising rates have caused 30-year mortgages to reach their highest level since 2009. Buyers are beginning to see the bright side, with inventory finally starting to improve, which could potentially mean more appealing prices. For the first time in what seems like an eternity, sellers are starting to lower their asking prices, and more than a dozen cities are seeing a fall, signaling that buyers may soon find some respite in a market near you. There will always be moments in history when an outlier occurs and the market will rarely follow the norm. For example, in 2020, the market saw the shortest bear market in history, falling 34% in a single month before returning to where we are now. Before that, during the Great Recession, the market plunged 56% in 17 months, and if you had invested at the high before the collapse, it would have taken you approximately 4 years to make even. The same can be said for the dot-com crisis, when technology equities lost about 80% of their value and took over a decade to recover if they were fortunate. Of course, there was a 36% and 48% fall in the 1960s and 1970s respectively, and many more throughout history. However, there is some good news in that. Now may be an excellent time to invest, because here is where the money is produced. If we exclude down of less than 20%, the average bull market has lasted 9.1 years with a cumulative return of 476%. And if we include declines of less than 20%, the average bull market has lasted 9.1 years with a cumulative return of 476%. The average bull market still lasts 4 years with a cumulative return of 129%, but it doesn't indicate the next bull market will last 48 months. Since if we go back in history, bull markets have lasted far longer. The shortest bull market since 1940 occurred just after the dot-com boom, when stocks soared 21.4% in 3.4 months, before falling 33.8% in the next 9 months. We also experienced a brief spell during the Great Recession when the market soared 24% in 1.5 months, before plunging another 27% 2 months later. Apart from those two instances, we have to go back to the 1920s to find anything analogous. There are several examples of bear markets lasting only a few days during the Great Depression, like a bull market that lasted 23 days and gained 25%. After that, there was a 42% dip, followed by a 1-month bull market that saw the stock market rise 30%. Not to mention that half of the S&P 500's finest days in the previous 20 years were during a bear market, and another 34% occurred in the first 2 months of a bull market before it was evident that a bull market had begun. This is because stocks, on the whole, are forward-thinking. So the greatest time to buy is generally before everyone else says it's the best. The truth is that if you buy regularly, regardless of where the market is trading, to keep for at least 10 to 20 years, you will never lose money. If you could just execute it on autopilot across a large index fund, you'd be able to generate a lot of money much faster than almost any other method. The truth is that when individuals are worried about their portfolios and resist the want to sell everything, it's a good moment to buy in at a discount. Because until you're a few years away from retirement, every market downturn should be viewed as a gift. After all, what if I told you that you could invest right after the market crashed by 80% in 1929? Or that you could invest after the dot-com bubble burst when investors thought tech stocks were doomed? Or that you could buy real estate during the 2009 housing collapse when people thought the market would never recover? Each of those occasions was a one-of-a-kind purchasing opportunity that would have rewarded patient, persistent investors handsomely. Now, this isn't to suggest that the market couldn't fall much more, because it most surely can and will. But for everyone who has ever expressed regret for not investing more money 2 years ago, this is a good reminder. This is your chance for one of the largest wealth transfers in recent history. If you have the income and keep to the ideas that have worked for the previous 100 years. Because as Warren Buffett puts it, the stock market is a vehicle for moving money from the impatient to the patient. As always, this video is for educational purposes only and not financial advice. You should always do your own research and speak to a financial advisor before making any investment decisions. Thank you for watching and see you in the next one.